FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz, and today is July 16th, 2019. We are right at the midpoint of the month. This was a year where selling in May and going away was just not going to work for you. You would have missed so much, so many advances in so many markets, gold in the stock market, Bitcoin. So maybe this is the theme of this year was buy in May and stay here until December and then get the hell out of Dodge. I'm not sure, but we've got lots going on here. We've got a Fed meeting coming up right at the end of the month, July 30th, 31st. Rate cuts appear imminent, but you never know. The Fed usually, well, we can talk about that more in a bit. But as always, you got an opinion on rates? You think they're headed? How far down do you think they're headed? We had a Bitcoin contest. Maybe we'll do a Fed contest or a gold or a silver one. Just stay tuned for that. The email address, kl@kerrylutz. Well, we have a new guest on, and it's kind of exciting. We're always trying to bring you new guests. The next guest is a currency strategist with a Dailyfx, and well, I think you'll enjoy his take on things. I know I will. His name is James Stanley. James, great to have you on the show. So, hey, first, you're a currency strategist, but I guess your analysis covers all markets, doesn't it?
Absolutely, yeah. And first, thanks for having me on, Kerry. What we do is largely macroeconomic outlooks, forecasts, et cetera. So that, of course, does impact international currency indices. S&P 500, of course, is right in the middle of that focus. And, what we have right now around the Federal Reserve, that's kind of our bread and butter, following monetary policy to see how it could make impact through global markets. And right now, the S&P 500 is on a sugar high. So there's a lot of focus on this macro theme.
Mm-hmm. So S&P on a sugar high from the intoxicant of lower rates and easier money for the people who really know what to do with it. Looking ahead, so we're talking about rate cuts at the Fed. It's widely anticipated. It's baked in the cake. 25 basis points coming for the end of July. You think there's a possibility they might just say, well, we'll see, maybe in August instead?
Yeah, I mean, if I was at the Fed, I would, and given the fact that, they have a dual mandate still, employment, inflation, both of those data points don't appear in dire need of a softer backdrop right now. I mean, unemployment's near 50-year lows. We have, and core inflation last week came out at 2.1%. Fed's target's at 2%. So, I mean, that is still doing okay. So it really does feel as though this is an insurance rate cut, a rate cut that's designed to keep equity markets afloat. But if we look at the backdrop, there are some very, very questionable factors. I mean, we have junk bonds with negative yields right now. We have emerging market debt with negative yields right now. I mean, these things aren't supposed to happen, but they're happening. And so what I think this is highlighting is some pretty massive distortion that's in the backdrop. And there does appear to be a disconnect. Even though the Fed is giving markets what they want right now and signaling a rate cut later this month, there is still a disconnect because rates markets are pricing in like an 83% chance, almost 83% chance as of right now, of 3 rate cuts by the end of this year. So far, the Fed has only really voiced acceptance or maybe even being open to just 1 rate cut. So the big question is what happens after July. Like you said, it's fairly well baked into the cake that we're probably going to get a 25 basis point move later this month. But we have to wait until September for updated projections, for the updated forecasts. And the big question is the Fed going to follow that with another rate cut? I think markets right now, especially equity markets and risk markets, they're looking at this as the start of something new. Maybe a rate softening cycle, if you will, after the bank was pretty aggressive the past 3 years. And we've seen 9 hikes since the December 2015 hike, or including that one. Mm-hmm. So, I think markets are very much riding on the assumption that the Fed is starting a new stance. They're going to be softer moving forward. so far, what we've heard from the Fed, it appears as though this is being looked at as a one-off, a reset, if you will. Chair Powell even denoted this last week in his congressional testimony for Humphrey Hawkins, where he had somewhat of alluded to the fact that the Fed had over-tightened, in the backdrop of Trumponomics. Everything was flowing really well. The Fed saw a really strong economy, so out of fear of overheating, they maybe went a little bit too far. Like that December rate hike last year, and how it really comes into question, because stocks already started to tip over as soon as Q4 started, and the Fed just stuck to their plan, hiked in December, forecasted another 2 for 2019, and they've been basically backtracking ever since.
Yeah, we do have the issue, though, that other country central banks have been cutting rates, and the administration has enunciated a policy. They don't want a strong dollar, or they might be somewhat content with the dollar where it is now. They don't want it going higher, back up to over 100 or even higher than that. And Europe is so weak, and the political situation is there. The banks, you've got Deutsche Bank, which is in a world of hurt right now. Obviously, they're not going to let Deutsche Bank go bankrupt, as it were, which I've said before. The definition, the etymology of the word bankrupt means broken table. And you would have the money lenders, I guess, in Venice or wherever. They would have bad loans. They would go broke, and they could no longer be in the money lending area of the market, and they break their table. So bankrupt means broken table in German. And I think it's German, yeah. And so we got some broken tables coming up here in Europe. The banks are in god-awful condition. The U.S., the Fed recapitalized all the banks effectively and bailed them out of the imprudence of the folly of their ways. They seem to be sticking to it a little bit anyway, although who knows what they've got off the books, all of the creative ways they've figured out to lose more money.
Yeah, Deutsche Bank is sitting on $49 trillion notional of derivatives. So, I mean, that's a massive derivative exposure. And, I mean, just this morning there was a report that came out that there was like $1 billion a day being taken out of DB accounts.
Correct.
So they're in pretty dire straits. And I mean, that's probably the quietest bank run we've ever heard of,
Yeah.
They're calling this a restructuring, but it seems that it might be a little bit more than that. But yeah, to your point, this is truly a race to the bottom. There's not a central bank out there, not a major central bank out there that's talking of higher rates right now. I think the big kind of X factor there is China, because in China you have a managed currency, the onshore yuan that is. And, in essence, whenever they're trying to offset some of the pressure from trade wars, they could just easily weaken the yuan. And that's something that we have seen play out over the last couple of years, where the yuan weakens massively, the dollar strengthens. That, of course, makes it more difficult for American producers or American consumers. And, it's simply a tool that isn't in the arsenal yet of U.S. government officials, because we do have that expanse between fiscal and monetary policy. From the purview of the Fed, their job really is to control monetary policy, short half-life. It really appears as though, and this isn't just with this rate cut, this goes back to last year when we had 4 hikes. It really appears as though the Fed is now using that power to, if you will, buffer fiscal policy a little bit. And we've even heard this in the headlines, because there's a lot of allusions to the fact that Jerome Powell's maybe looking at a rate cut to offset pressure from trade wars. Maybe that helps China. I don't know. But, there is a disconnect there.
Mm-hmm. There's definitely a disconnect, and we got like a kind of crazy policy. So the question is, where do we head from here? I think these rate cuts probably are coming. Going back to Deutsche Bank, $1 billion a week or so. You've got like crisis situations in many European countries that we just don't hear about in the U.S. because we just don't hear about it. They don't think it's worth letting you know about it. But what we're seeing is flight capital coming from many different places in the world, and that is got to be cause for concern.
FSN Radio. It's all about what's next.
Today's show is brought to you by U.S. Gold Corp. U.S. Gold Corp is a U.S.-focused gold exploration and development company advancing high-potential projects in Wyoming and Nevada. U.S. Gold Corp has consolidated a district on Nevada's productive Cortex trend and is advancing the Copper King project towards production in Wyoming, led by a team of prolific company builders and renowned explorers, including Dave Mathewson, who is directly responsible for several major Nevada gold discoveries. U.S. Gold Corp is well capitalized and has an extremely tight share structure with less than 20 million shares outstanding and trades on the NASDAQ, a major exchange, under the ticker symbol USAU. To learn more, go to usgoldcorp.gold. That's usgoldcorp.gold.
The Financial Survival Network. It's all about what's next.
Yeah, definitely. I mean, when you're the only game in town with positive rates, you're going to get a lot of capital flows, especially when you're the U.S., especially when you are the sole global reserve currency, which is what we are. But that's a multi-pronged type of issue, because if you are the sole reserve, if you are seeing massive capital flows in a flight to quality or safe haven type of run, well, that really exposes your economy to a lot of different pains. It's somewhat similar to what happened to Japan in the 90s and then the 2000s, the quote unquote lost decades, where a really strong Japanese yen made the prospect of exporting just that much less advantageous. And I mean, even today, if you look at a chart of the Nikkei, I think we're still like more than 50% below its 1989, 1990 high. Mm-hmm. And a lot of that was brought upon by just a really strong Japanese yen. And we'd heard Janet Yellen talk about this when, shortly before she ended her tenure, where, she had kind of expressed the concern that once the U.S. starts raising rates, if other economies aren't also raising rates, then it really does expose American producers to a lot of different ills. And, and that's something we've seen Trump talk about on Twitter, numerous times in the past. Just on a personal basis, a lot of friends that I have that work in importing or exporting, this is something that they've noted as well. So, we are at somewhat of a crunch time where something is going to happen. We just don't know exactly what. In relevance to the Fed right now, it looks as though the big question is how far do stocks move after this rate cut, and whether or not they could signal another rate cut on the horizon. It's going to be a challenge, because the Fed's really attempted to be, it appears that they've attempted to strike a tone of stability so far this year. When markets were pulling back in Q4 of last year, they still hiked in December. They still forecasted 2 hikes in 2019. And I mean, I think that was a pretty big deal, because the immediate response in equity markets was brutal. And in some markets, that even lasted into the open of the new year. Like if you look at the Japanese yen, there's a significant surge of strength in the first couple of days of this year, largely on the back of that same theme. But throughout Q1, we saw the Fed backtrack a little bit more in Q2. The month of May is, beginning of May is when we had a FOMC rate decision. Fed didn't get that dovish, and then stocks started to tank again, and tanked for most of May. Caught support in early June. Lo and behold, Jerome Powell gets dovish all of a sudden. Stocks ramp right back up. But that's also when we started to see some dollar weakness get into the equation. So, a pretty clear pricing in of a lower rate paradigm around U.S. forecasts.
Mm-hmm. Interesting. So we're in unsettled territory, but certainly it's going to be dovish. What will be the result? You think we're going to see increases in the stock market that far eclipse what we've seen so far? Everybody likes to think that this thing is over and it can't go any further, but it just when you thought the stock market couldn't go up anymore, James, it keeps going up. Why is that?
Right. Yeah. I mean, it's the sugar high. If you're an American corporate, I would argue that the last, say, 12 years, 10 years at least, have been as accommodative as any time in history. Not only are rates extremely low, but we now also have a president that can push the stock market up at will. Yeah. The business backdrop has become a lot more friendly for entrepreneurs, and it really does create, a great environment for doing business. And it also does, it decreases the opportunity cost of investing in research and development, which I think is great on a longer term basis, because that's how we get new drug discoveries and things like that. So there is a positive to be had from a soft monetary backdrop, from a very passive Federal Reserve. Mm-hmm. The big question is, for how long can this go on, right? Yes. And I think for that, the best market to follow is gold, because whenever we get this inevitable, almost unified front from central bankers looking to go looser, looking to go weaker, gold is usually what prospers. And that's what we saw in the month of June. Gold had a huge month. I think it was up almost like 13%.
Yeah.
Peak to trough, or trough to peak.
Yeah,
and that was largely indicative of that shuffle at the Fed. So far, that move has started to stall out a little bit. Just from those highs that were set a few weeks ago. But, it does look as though it's primed to move higher. I think it's first going to make a move lower around this FOMC rate decision. And then that's when I think the terminal part of that bullish move is really going to get started. And I could see it going up to 1,700, within 18 months.
Yeah, I think so. Gold analyst at Kitco by the name of Peter Hugg, been following this for 30 years. So he's seen a couple of cycles already, probably only 2 cycles, really. This might be the third. He's calling for 1550 gold by the end of the year. If everybody is inflating and it's a rush to the bottom, that's not too hard to envision. And he could wind up being very conservative. We still have 5 more months left to this incredible year. So, hey, we got your overview on things. It's going to be an interesting time ahead. James, people want to find out more about you, connect on the web. Where do they find you?
Best place is probably Twitter. It's kind of the financial hub anymore. But I'm at J Stanley FX, just all in one word, JSTANLEY FX. But I converse with a lot of folks there, share a lot of my research there. Pretty much all of my writing is published on Dailyfx.com. Most of it is free, available to whoever wants to read it. And we usually enclose quite a few good charts, themes, good commentary, stuff like that. Really good site for folks that trade.
All right.
Or you can just follow markets at all.
Okay, cool. All right. Well, we like it. Hey, any questions, comments for James, myself? We welcome your feedback. The email address is kl@kerrylutz.com. The Twitter feed is @KerryLutz. We're going to become much more active on there. I figure if it works for the president, it certainly can work for us. The Facebook page is Financial Survival Network. We'll be more active there as well. James, been a pleasure having you on, and we'll look forward to speaking with you again.
An absolute pleasure, Kerry. I really appreciate your time today. Thank you.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.